Hi, I'm Chuck Gibson. This is Taking Stock with Art Jarvis, a bi-weekly discussion of what is happening in the economy, the world of finance, and personal investment with Art Jarvis. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Now here is Taking Stock. Well, welcome back, Art Jarvis. Episode number 23 of Taking Stock. So how are you on this Tuesday, the 23rd of April?
I think I'm fantastic. Yeah. So, as always, happy to be here and looking forward to talking a little economics and stocks and bonds and all that good stuff.
Oh, excellent. Yeah. Stocks and bonds.
Yeah.
I don't have that in my
notes.
You
don't have it on your notes?
Well, you'll be doing the talking about that, thanks be to God. Not Chuck. But right off the bat, things over the last, and I should be honest. This is episode 23 of Taking Stock, and there might be some people when they listen to this one and say, I thought I heard. Well, we had a snafu, and so this is Taking Stock, episode 23. Forget whatever you think you heard.
Right, exactly.
This is the real thing.
Yeah, I'm a big believer in people should get their money's worth, right? So this is us making sure people get their money's worth, right?
Yeah. No explanation for the technical glitch that occurred, but nonetheless, so here we are on the 23rd, as you mentioned a moment ago, on the 23rd, Taking Stock, episode 23. And let's get right into the economics and what's happening in our economy nationally, and then globally, and then let's hit home too.
Okay, yeah, definitely. The last 2 weeks have been interesting. And what is interesting to me is a lot of the things that you and I have been talking about for the last 4 months or so have begun to come to fruition. So, our discussion about, it's ridiculous to be talking about 6 rate decreases this year, and then we've slowly moved from that to, it's like, okay, well, hopefully, and then all is like, well, hopefully we'll have one, and then, Fed Chairman Powell came out last week and basically said, hey, we might not have any rate decreases until March of 2025 to not to be a smart aleck, but to which I said, yeah, no kidding. So, but,
politely.
Here's the problem. We were at 9% inflation. So to get from 9% inflation down to that 3 or 4% inflation, it happens relatively quickly. Okay, you're stomping on the brake, you're raising rates 11 or 12 times to try and just slow it down and try to drag that inflation horse back into the barn. The problem is now they're trying to get from, let's say, 3.5% inflation down to, they want 2% inflation. Well, that could take 2 to 4 years to make that happen. So, but you still sit there, and you mentioned the economics. We're still looking at 3.5% inflation. We're still looking at 3.2% unemployment. We're still looking at a consumer that's rocking and rolling. The last gross domestic product number was 3.3%, which is fantastic. We've said it before. There's just not a good reason to lower rates, because lowering rates is the equivalent of pressing harder on the accelerator, and this economy at this moment in time doesn't need any more juice. Right?
Well, and again, when we've talked, that accelerator versus the brake, raising the rates, pumping the brake, lowering the rates, turned out to be more than easing off the brake. It became pumping the accelerator, like you talked. I was amazed to see some of those numbers over the last 14 days for somebody who doesn't pay that close attention, but just what I did see or read about or hear about peripherally, the fact that the inflation rate jumped a little bit again. And it's like, man.
Yeah. Well, and they were expecting it to go up. So we were at 3.2, and they were actually expecting this is the consumer price index. They were expecting it to go from 3.2 year over year to 3.4. So there was already that expectation, but that moves away from the trend we've been on for about a year. The problem is not only did it go up, it went to 3.5. So, now you're looking and saying, okay, not only did it go up, it went up more than expected. Once again, only one data point, right?
Right.
But so it's not a trend yet.
Yeah.
But that caused interest rates. So if you look at the 10-year Treasury, we were just say roughly at 4.25%. Well, the next thing you know, we're in the 4.6s. And I think when we were talking last Tuesday, we were at 4.67. Today we're at 4.6. So that in a couple things. One, that the expectation for a rate cut this year, or a couple rate cuts this year, has greatly diminished. Okay, we've gone from, hey, we're going to have 6 rate decreases to we might have 1. Okay, and so that expectation is gone. So that's taken some of the fuel out of the psychology part of the market, if that makes sense. So you've had that happen, and in spite of all the numbers we've had and everything, and all the kind of tit for tat thing we had going on with Israel and Iran, I don't want to make light of it, but I guess it was handled as best as it could be. I don't know. I'm not a master strategist, okay, but I mean, in spite of all that and the volatility it caused, we lost probably 5% return last week in the market. We had 6 down days in a row, and that was all one because of the uncertainty, once again, of what's going on in the Middle East. Everyone's concerned about it escalating, becoming something bigger. But then really the more important backstory is the fact that the interest rates moved up, because the expectations have changed for that rate decrease.
That again, that's a lot of information, and I want to go back up to a little bit to the beginning of that when you talk about. So there was an expectation that there would be an increase year over year, and so that's what I want to go back to, year over year. So when you said it was 3.2, and then year over year increased to 3.5,
that's correct.
So to help me and others like me who are listening in, understanding that year over year. So that is compared to 2023 it increased 3.5%.
That's correct.
Compared to 2023.
Yeah. So theoretically, if we continue to use the cheeseburger analogy, in 2022 the cheeseburger went up 9 or 10%. And it's not going up as fast, but yet, if you look at it year over year today, you're still 3.5% higher than it was a year ago.
What I want to know, as we keep talking about the cheeseburger, and it works great because people can see and feel and understand that in a hurry, and they can notice it when they go out, and whether it's a fancy cheeseburger or just your regular cheeseburger, they can see it. Yeah. They can feel it. And hopefully they can taste it.
Well, yeah, it better taste really good.
I was going to say, we're on the same page. It better taste good because the price went up. But so my real question at the end of that, just for fun, is, so how are the cattlemen doing? I mean, the guys, the cattle farmers, they must be doing okay.
Well, the problem is the cattlemen have to feed the cattle.
Darn it.
So you have the cost of feed and corn and grain or whatever they feed the cows, and it's.
I'm not buying it.
Well,
I'm not buying it. I'm not buying that the cost of the feed and everything for the cows has gone up to in that measurable number. I think it's more at the restaurant.
You think?
I don't know.
Well, let's be clear about something. The feed cost will fluctuate. Like if you're a farmer, and I don't care if you're planting crops or you're raising cattle or chickens or hogs or whatever it is you're doing, your cost of doing business to take care of those things and feed them and keep them healthy and all that fluctuates greatly.
Right.
But you're right. If a cheeseburger is $10 today, it's not going back down to $9.50. Okay, they're not the cost of that. We're in the world. The prices we're seeing now, generally, depending on the elasticity of those prices, we're pretty much stuck with them.
Right.
How's that for
No,
bright and sunshiny?
and we've covered that. It's really nice when you hear that, a year ago or so, it was 9% inflation rate, and it's down to 3%. Well, that is still an inflation rate that the prices are inflating, the cost of goods and services is inflating at a rate. It didn't drop 6%.
Right.
It just, the rate of inflation slowed to 3.5 or whatever.
It's funny to me that, we have spent a lot of time talking about inflation over the last, 9 or 10 months, right?
Sure.
And it's just amazing. Like, we went for easily a decade where it just wasn't really a conversation. It was kind of under control, and it was in a nice little sweet spot. It was going up, but it was going up 2%, 2.5%. Now, everyone, you see it. It's in your face. It's your gas and electric bill. It's your gasoline. It's your trip to the grocery store. It's your entertainment. It's your, your food. All that stuff. It's in your face now. And the thing is, it was with the increase in technology and how they were able to do things. It was very hard for the producers to pass on increases in price. Well, since COVID, moving forward, it's become much easier to pass. It's just expected, right? The supply chain was messed up and continues to be somewhat not back to where it was before, but it's almost an expectation that prices are going up.
Well,
it's become a lot easier.
Does consumers, you, me, and every other consumer, asking questions about why, does that make a difference as opposed to accepting, this is what happened, and so, the prices are going to go up? If we're just accepting that versus where do you stand up and say, you know what, hold on here a second. These higher prices aren't a true reflection of the cost of whoever doing business or whatever the case may be. They're just, we've had this before. We've seen this. You and I in our lifetime have seen when there was price gouging.
Oh, definitely.
And so, are we at a point where maybe there's some price gouging going on too? Or is it just there's been some legitimate, cost of doing business increases that are being passed on to the consumer in a fair way?
I'll hit you with the yes. It's
I hate that.
Yes, there are legitimate increases. They are legitimate. If you look, and it's like the price of business has just gone up. Look at wages. Wages are increasing at 5.1%. If there's certain industries where personnel and everything associated with human capital. It's a big chunk of their costs, right? So it's legitimate, And you look at like United Auto Workers, however many months ago, I think they got a 25% increase over 3 years, I think it was, and but at the same time, there's a little bit of that playing catch up. I think we talked about before,
right?
We had 10% inflation, but they were still getting 2 or 3%. Increases in wages. Well, they are in some ways, them and a whole lot of other industries. They're trying to play catch up to how they fell behind over the last.
Well, as we do in our own homes.
Sure.
It's like, hey, we are living on whatever wages and earnings or salaries or whatever investments that we have. If they don't keep up with the inflation. Then if you're an employee, you're looking to your employer to help me catch up.
That's right.
Shoot, even those who are on the fixed income, retirement, Social Security, or whatever. Beyond Social Security, your investments keeping up? B, Social Security. Well, Social Security does in fact do a cost of living.
Sure.
Increase.
And we went for a decade almost where you were getting a 0% increase every year, or you're getting a 1%, and then all of a sudden, 2000, if I get this right, 2022 or beginning of 23. Beginning of 23, I think you got an 8.7% increase in Social Security. I believe beginning of this year, 2024, I think it was 5 point something percent that it increased. So so that is being reflected in the retirees and Social Security. But you make some bad things. There is a such thing as deflation, right? So prices can come down, but very not so good things have to happen in order for that to occur. And that you're talking about bad things happening in the economy, so you get your prices to start coming down because people aren't spending and demand goes down, but you also have the value of your house going down, you have the value of your 401ks going down. It's nice to have lower prices, but not at the cost of everything else in your life.
Right.
Honestly, the best way, in my opinion, if you want to keep people honest and keep producers honest and things like that, is you vote with your pocketbook. If you think a hamburger is too much, well, number one, you stop buying hamburger and start buying chicken or something along those lines. You find something complementary to that, and if it happens enough, that demand drops, then Economics 101, if you want demand to go up, lower prices, right? So I mean, you as it's one of those things. It's kind of like, I'm not going to get into that, but it's kind of, if we get together and make a decision and start doing something, if millions of people start doing the same thing, they have to react, right?
Right.
So we're not at that point yet.
Well, and again, going back to that base of my question, that's the concern. Do we, the people, need to stand up and question the continuing increases? I mean, people, we see it ourselves in our own home, but you also hear it from others. It's like right now, one of the big things is you touched on it, not just gasoline for your car, but the cost of energy to supply your home with electricity or gas, gas and electric, whatever, to run your home on there have been considerable increases there. There are government regulatory commissions that manage that to some degree, but at the same time, those increases have happened.
Sure.
So where do we stand up and say, wait a minute, and where do we go on? So that was, that's the answer to that question.
Not to be cynical, but you have government organizations managing it, so they don't exactly get my utmost confidence. Let's put it that way. Yeah. So I'll leave it at that.
Well, we've talked about very clearly over the recent months. Can't understand how they can be looking at 6 or 7 interest rate decreases. But now, over the last couple of weeks, a little bit of a jump in the inflation rate, and clearly everybody's saying, well, Jerome Powell, 2025, we're pushing that back to 2025. However, as you and I were talking offline, now people are like, well, wait a minute. Are we going to see rate increases? What is Art Jarvis telling me?
Yeah, well, the probability of that at this moment in time, I think, is very low, like less than 10%. Okay, but yeah, it's a legitimate. Well, if we're not going to get rate decreases, does that mean we're going to get? Yeah, and again, this is not an easy process. Like I said before, this could be a 2 to 4 year process to try and get this down. I can't tell you what the probability is, but if I'm looking a year, maybe we don't get rate decreases in 2025 either. I mean, we need a whole lot more data points to make that decision. But
we're only end of first quarter 2024.
Right,
so,
exactly. But could we get a rate decrease at the end? But things have to change. Like something had the consumer, and that's another interesting number. The whole time we're dealing with all these inflation numbers, and as we always talk, the consumer is 70% of gross domestic product. Well, we also got a retail sales number, not last week, but the week before. They were looking for it to grow 0.3%, and it grew 0.7%. So not only was it a positive number, it was way better than expected. So I keep saying the consumer is in it to win it, right? They're still participating, in spite of the fact that inflation continues to move.
I like to think, because you've allowed me to think of myself as sort of the host of this taking stock.
I allowed you.
Well, I'm just saying, somebody else can decide that. Maybe we shouldn't together. But regardless, so Art Jarvis is the expert in this show. But you just beat me to the punch. I was going to mention to you the retail sales,
okay.
And there's always a question. So if I'm the host, I'm mad that you beat me to the punch because I'm supposed to lead you there.
Once again, sorry.
That's okay. That's okay. It's good. No, you got there with it was osmosis. But there's always a question, or at least if I'm doing my job, there's a question. So retail sales number, as opposed to the 3%, it was 7%. And I know there's talk out on the streets. Well, the retail sales numbers, everything's much more expensive. How much of that retail sales number is because, put it this way. Retail sales is an actual sales number. And that actual sales number is, $10,000 sales compared to, $7,000 sales. So there's that percentage of increase.
Right.
The prices went up.
They did, yeah.
By, somewhere originally 9%, but, with the inflation rate. And that didn't change, but it continued to go up beyond that at a rate of about 3.2%, up until jumping slightly again over the last couple of weeks.
Sure.
So retail sales went up about 7%.
0.7%.
0.7%. Yeah. Thank you. I want to get that right. So 0.7% increase in retail sales.
Yeah.
And that retail sales number was for a quarter?
That's a monthly number.
Okay.
So, I'm glad you bring that up, because we throw quarterly, we throw annual. That's a monthly increase.
Good.
Yeah.
Okay.
Yeah.
Well, how much of that do you, Art Jarvis, attribute to the cost of goods?
Yeah, and I can't give it. I'm going to say some. Okay, you're asking a great question, and you're making a. This is why you're the host. It's a great question, and it's a great point, because you're right. Because then you start looking at what I would call the real increase. So you can say gross domestic product went up 3%, but if you got 3% inflation, then you're like, it didn't go up from real terms. It didn't go up that much, right? So it's the same thing with retail sales. I would submit to you, though, that the fact that it grew on a month-over-month basis at 0.7%, that's more than what would be attributable to inflation. Okay. So and the fact that it was more than double what they were looking for in the first place, and you take that and put it in there with a bunch of months stringed together. Again, I talked about I'm worried about the trends, not one data point. You take that number and put it with all the numbers we've had for the last 6 to 12 months. That tells me that we're not losing the consumer yet. Okay, or we're losing.
And I was going to say, so the summary of that 0.7% for March retail sales, I guess that's what was reported, was the March.
That was the March numbers.
The previous month,
correct,
because it was the second week of April that was reported.
Right.
So, but that 0.7% for March, the summary is some of that's attributable to the cost of goods. So that obvious. It has to be, because the dollars that went into retail sales are part of the price. So,
right.
But two, over the longer period of time, the Art Jarvis look back over 6 months, it says the consumer. So the real number is, yes, consumers haven't bailed out. The consumers are still spending, and so that'll bring us. We're getting close to the end of episode 23, Art, but that brings us to what are some of the numbers, like right now, today, here we sit recording this on this Tuesday, April the 23rd. What are some of the things that you wanted to share with the listeners about the latest numbers? Again, you mentioned the 6 days. We had the 6 bad days, ouch, and a 5% loss over those. But the last, Monday, yesterday, was not bad. What are you seeing in the early hours of this Tuesday?
It's up over 1%. I think we're up like 1.15% today. So again, you've had the interest rates have moved down slightly. I mean, nothing to get all crazy about, but the concerns and the uncertainty in the Middle East have eased. It's I live in Loveland, Ohio, United States of America, right? So the Middle East, what goes on over there, and it's been going on for so long, and it's a cart and the horse or a chicken and the egg thing, right? It's they say, well, they did this and they did that. It's like, yeah, well, you can't, you're gonna have to go back decades to even try and sort this out. But in my opinion, it if you could say this, it turned out, I guess, the best that it could, and they made a calculated response, and really didn't try to do anything major. So
not escalate into a full-blown war.
Yeah, they sent a message. It's almost like, hey, we just want to let you know what we can do, but we're not going to do it, but we're going to let you know it can happen. And they were able to, the Iranians were able to defend the response, and so I guess it's interesting to me that you get conflicting stories, but you have satellites up in space that can see a dime sitting on the sidewalk, right? But no one can show us a picture that whether a missile hit something or anything like that. So, but the point is that concern, and that has much like the Gulf War. The Gulf War was much the same, just longer. That the war part of it happened relatively quickly, and then it became more of a occupation kind of thing. So, but when that happens, you will see. So consumers will get scared. So you'll see consumer confidence numbers drop. But then it's like, oh, look, things are going really well. The consumer comes right on back, and you'll see that. So here's the trend. And I'm using my hands right now in case you're interested.
I'm watching his hands. I'm not going to try. I'm not going to try to describe the action.
I got to remember this is a radio show.
Left hand above the right, and they're shuffling back and forth.
Yeah, that's right. Yeah.
And it's showing a balance and a tempered response.
It's the 20% Italian in me coming out.
So the third baseman is playing straight away on the right-handed hitter. The shortstop, for some reason, is edging him a little bit towards second. So we're looking for a fastball here that the guy's not. He's going to be a little bit behind. Yeah. I can do the baseball play-by-play.
Yeah.
Art's hands with economics is a little bit more challenging.
This hand is the upward trend. This hand is the deviation from the upward trend, and then getting back to the upward trend. How's that sound?
All right, perfect. So now, for you listening, all kidding aside, so the left hand is the trend, upward trend, and he had that 3 to 4 inches above his right hand, which was curling down below that left hand upward trend, and that's so there's been a slight deviation, but it's just only curling. It's not settling, and it's not climbing above it.
Yeah, it comes generally in something a short term. I'll use the word skirmish. It tends to come very quickly back to the trend that you were on in the first place. So that's what I'm looking for. But here's we're talking about numbers. We're not in a position like we lost, let's say 5% last week. So instead of being up 24%, we're up 19% on a year over year. So I'm good with 19% return, right? But completely lost my train of thought. We're up to 20, but there's not like I'm sitting here looking at interest rates and looking at the potential earnings on the forward earnings and things like that and saying, hey, we've got potentially 20% upside on this market. We're kind of sandwiched right now between we really don't need to go this far down, but we really don't have that much upside right now either because of where interest rates are and because of where the earnings numbers are. So either we need the interest rates to start dropping back down again, and that's the whole problem with the Fed saying, hey, it might be March now. Everybody's expectations have changed, so their target number for the markets has now dropped. But at the same time, there's nothing. This economy's moving well, and the economic numbers look good. I'm also not sitting here going, hey, we could possibly get a 10 to 15% drop in the market either. We could potentially stay in a tight range here for the next 6 to 12 months.
And that's good enough.
There you go. It's a mouthful.
Stay the course.
Plus, my hands are tired.
He has them clasped together as he says his hands are tired. So, well, thank you once again for another great session of Taking Stock, helping us take stock of where our economy is, where our investments are and may go, and hopefully upward. It sounds like it's an upward trend, at least for this week again compared to last week. We're week over week right now.
Well, yeah, just for this one, because once again we wanted them to get their money's worth.
Well, Art Jarvis, thank you so much for joining us once again and taking the time to share your insights.
No, thank you, and again, I say it every time. I really enjoy this process, so hopefully it's helpful to some other people.
Well, I'm learning if no one else is.
There you go.
So, all right. Well, and we'll be back next week with episode number 24.
Sounds great.
Until then, thanks for listening.
Yeah, thanks, Chuck.
Thanks for joining us for this edition of Taking Stock with Art Jarvis. Join us again in 2 weeks for our next edition. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Jarvis Global Investments, LLC is a registered investment advisory firm. The advisor is not attempting to furnish personalized investment advice or services during this production. Individuals should fully investigate the appropriateness of any investment before investing. Past performance is no guarantee of future results. Investments may lose value.